Alright everyone, Cowboy Trades here, welcome back to the channel for another update on Bitcoin. So in the past 24 hours and since our last warning video, Bitcoin has taken another lower leg to the downside. So we're going to do something a little bit different in this video. Instead of starting off on the higher time frames and working our way down, I'm going to start off on the lower time frames and we're going to work our way up price target by price target, chart by chart, and I'm going to let you know how I think Bitcoin is coming down to this $10,000 area. We're going to talk about Bitcoin, then we're going to move on to the S&P 500, then we're going to talk about a few very important charts and update what has happened since I made my last video. So let's dive right into this. Starting off on the 1 hour time frame. Now it looks like this bearish flag, bearish pennant, whatever you want to call it, dragged on for quite some time, almost very similar to the previous range that we just saw over here. But you can see we have now broken to the downside of this, confirmed this as resistance, and proceeded to break down to the downside. So before I give you the price target of this, if we just quickly come over to the 4 hour, we have been talking about this bar pattern with a price target down at 21,400. So that would be the first price target to complete, and after we do complete this, as you can see, once again, back over on the 1 hour time frame, we have another lower price target down here at 20,500. Moving on to our next chart, focusing on the 4 hour time frame, you can see that we currently have this nasty M pattern playing out right now. Now we're going to revisit this chart in the higher time frames in just a little bit, but as you can see, the price target of this M pattern is actually all the way down here at 18,850, which from where we are is about another 15% drop. Now coming over to the daily time frame, this is actually just a zoomed out version of the M pattern that we just looked at, but I want to focus on something different. As you can see right here, this is what regular bearish divergence is. Regular bearish divergence forms where you've got highs in the price chart followed by highs, higher highs, higher highs, higher highs, and when you look at the oscillator, you have highs, lower highs, lower highs, lower highs, lower highs, and lower highs. Now, while we don't have a linear trend line on this, this is a curvature line. This is still 100% valid. You can see, as you can see right over here, this is regular bearish divergence forming at this moment in time. Also, while we are still on this chart on the daily time frame, it's quite nice to see that the long-term moving average of the EMA ribbon is pushing Bitcoin to the downside of this M pattern. And you can also see that we do have a candle body right now trading underneath this M pattern. So on the daily time frame for today, really keep your eyes on if Bitcoin can close above or below 22,200. We're currently at 22,000, not looking too good right now. Now coming over to the weekly, let me just reset this chart. I have so many charts for Bitcoin, so I do need to use this one once again. We have obviously talked about on the channel how we quite recently broke out of this trend line, but where did we run up to? We ran right into the 200-week moving average, and we're currently getting a strong rejection. So we're kind of sitting between no man's land right now, sitting slightly above that macro trend line, sitting right underneath the 200-week moving average. But as we have just got rejected from the 200-week moving average, if we look at the oscillators are telling us that we're far more likely to lose this macro trend line than to backtest it and start zooming up to the upside, because on the weekly you can see the stochastic RSI has just crossed bearish and is starting to head down. The last time this happened, we broke down into new lows. The time before this that it happened, we broke down into new lows. The time before that this happened, we broke down into new lows. Of course, talking about the bear market lows. MFI is right now at 67 with lots of room to move to the downside, and the squeeze momentum indicator is currently sitting in green territory, indicative that bears in the higher time frames are not actually the ones that are running this trend. It is bulls. We've completely reset momentum, and of course in a bear market, resetting bearish momentum is just a sign that when bears do step back into this market, it's going to be very, very nasty. In fact, you can see what happened the last time bulls started to lose momentum coming into this bear market. It was not a pretty picture. So we've got a lot of momentum carrying us back down to this trend line. This brings me over to my final chart for Bitcoin. Now, first of all, before we look at this on the weekly time frame, let's come back over to the daily, because I want to focus one more time on this pattern that we're seeing right here. We did talk about this being an M pattern. We did also talk about this being bearish divergence, but if we look at this, this is actually a fractal we've seen play out a few times. We had an M pattern with a upwards trend line, and we had a higher high form quite a few times. We had this right here, an M pattern with a higher high. This proceeded to have us break down 26%. Over here, you can see an M pattern with a slightly higher high on an uptrending line of support. This broke us down to a 28% drop down into new bear market lows. And as you can see, we're kind of just figuring out if this is an M pattern. On the daily time frame, once again, keep your eyes on 22,200. If we close beneath that, it's looking like we could get continuation down to this price target at 18,800. And as we've discussed going through this video, price target by price target, we're going to start slowly chipping away and breaking to the downside. Now, while this is a fractal, while this M pattern could carry us down to 18,700, there's another price target. As you can see right here, if we clear this up just temporarily, get a different color, mark this as orange, you can see, as we've also discussed on the channel, this is a lengthy bark pattern right now with a price target down at 16,300. So as you can see, you know, the more we zoom out and the more we look at these price targets, the lower and lower it gets. And if we do look at our final price targets coming over to the weekly time frame, if we do start getting down to these regions, we start falling into an area where there's not much liquidity traded. Now, if we clear up this chart very temporarily, you can see there is an area that we could potentially come down to down here. This is the previous touch points coming into 2019. We've got touch points at 14,000. We've got touch points down here at 12,500. We've got touch points, candle body closes, 12,000 on the dot. We've got candle body closes at 11,500. But what I'm looking at is this big area of liquidity right here marked with this orange box. If we take our volume profiles, put it from the bear market lows, basically we're looking at all of the volume that has been traded in the most recent bull market, starting off with the bear market lows from 2018 coming into 2019. So with this, when we are looking at this, yes, the most amount of data that was traded around here is 4,000. Am I saying we're going to come down to 4,000? Absolutely not. I think it's far more likely that we come down to this big area of liquidity trading between $10,700 all the way down to $8,850. Now, at this moment in time, I'm personally targeting areas like 14,000. I'm targeting areas like 12,000. I'm targeting areas like 10,000. If you have been watching the channel, you actually know that as we started to break down into new bear market lows, this was round about, I believe this was the FTX crash, round about June. It may have been this crash over here, but nonetheless, we bought coming down into this area down here in June. We bought at 25, 24, 23, 22, and when we broke back down and made new lows, we bought all the way down to 16,000. I've still got buy orders set at 15,000, 14,000, 13, 12, 11, 10, 9, 8. I don't necessarily think that we go down to 8, but once again, I'm well positioned. If we do break underneath this 15,000 area, I'm not going to be waiting for 10,000, even though I do think we're coming down here. I am going to start once again rebuying at 15, 14, 13, 12, 11, 10. And if we do go lower than I expected, if we do break beneath 10K, I will also be prepared to deploy capital at 9K, 8K. We'll start talking about lower price targets if we do get down to 10K, but at least at this moment in time, I do think this 10K zone is a magnet, and this is where I do plan on deploying much more capital back into the markets. Now, outside of this $10,000 price target going on Bitcoin, for this video so far, we've only looked at BTC charts. And as you know, if you do watch the channel, we like to give you a broad perspective on the markets. As an economist, I think it's much more important to look at the macro economy, look at different charts in the stock market, rather than just looking at, your basic BTC USD chart. So that's what we're going to move on to right now. Now, let's start off on one of our favorite liquidity charts. This is on the E-mini futures for the S&P 500. As you can see, there was a liquidity top here, liquidity top here, liquidity top here, liquidity top here, and a liquidity top here. We've plotted these liquidity tops over on this chart in the S&P 500. Veterans of the channel will remember this very well, and this is an important fractal that I want to discuss with you right now. So you can see with each of these liquidity tops, what is interesting about these is we break down and we have a strong buyback. A buyback in terms of both liquidity. You can see top, there's a buyback before you break down again. You can see a top, breakdown, buyback, breakdown again. You can see a top, breakdown, buyback, breakdown again. You can see a top, breakdown, and then over here, you can see that we did actually have a higher liquidity top, but we broke down, and it looks like we're having another buyback. So over on this chart, you can see this breakdown and buyback retested the 618 Fibonacci. Over here, this liquidity top, we had a breakdown and we had a buyback, which almost came up to your 0.5 Fibonacci, although you can draw it to this low down here, depending on how you want to draw it. I personally think it looks better from down here. Almost came up to the 0.5 Fibonacci. From this liquidity top, drawing down to this low before this bounce, we came into the 0.5 Fibonacci, didn't quite hit the 618, but most of the time, we're in the golden ratio, we're close to the golden ratio, we're in the golden ratio. Over here, it's a little bit more clear in the chart. We had a weird thing play out over here where we actually topped out. We broke down for about 2 weeks, and then I believe there was a news event or some economic data that came out at this point, and we actually reversed right up to this top. So you can see a breakdown, a buyback, and then another breakdown. And over here, has anything changed? We've topped out again in terms of liquidity in the macro time frame, and if we're drawing from our swing high down to our swing low quite recently, I'll come over to the daily so you can see exactly where we started to come down to. We had that massive breakdown. In fact, from this top up here at 4,200, we broke down 6.35% all the way down to 3,929. We pumped back up to 4,078, coming once again right into this golden ratio. We have seen this fractal of a top in liquidity, a breakdown, and a buyback preceded by a retest of this golden ratio, or almost coming into this golden ratio so many times. So this is another reason kind of letting me know that, hey, this S&P 500 fractal that's been playing out again and again and again and again and again is probably telling us that we're ready to come back down to new lows. Also, in terms of economic data and news that you may have missed, I posted about this over on Twitter yesterday. I will give you a quick summary of this. We had the United States Federal Reserve Chairman Jerome Powell testifying before the Senate Banking Committee. I listened to the entire meeting, which was hours long, and I gave a quick summary of the important data over here, so I'll just fly through this quickly for those of you who have missed this. Powell basically stated economic data in January partially reversed economic trends in the previous month, meaning they thought inflation was coming down, but then, basically some economic data, especially not just inflation, but I'm generalizing outside of inflation as well, is showing us that the trend may be reversing back to the upside again. He said that revised data in January suggests that inflationary pressures are running higher than their previous FOMC meeting. He stated that ongoing increases in the interest rates will be appropriate. He also said that the Fed do not want to stifle cryptocurrency innovation, but they currently see large amounts of fraud which needs to be cracked down on, particularly in the stablecoin sector. But when he said, recently we're seeing large amounts of fraud, I'm pretty sure he was referencing the FTX scandal. Also, Senator Kennedy came out and suggested that a recession is looming and 1 in 10 Americans could be out of work. He was basically looking at some economic data and previous fractals, talking about how Jerome Powell basically wanted to raise the unemployment rate. And he pointed out, looking at previous data, when the unemployment was raised to the levels that Powell was discussing, that basically a recession would be looming because of this, and 1 in 10 Americans would be out of work. Powell also said the only way out is for Congress to raise the debt ceiling, and he said that the Fed funds rate will likely peak above 5.5%, which is very interesting. If we do come over to the Fed futures right now, they're currently actually priced in just higher than 5.5%. You can see they're currently looking around about 5.54%. Today they came up to 5.85%, and I've marked over here, you can see yesterday Powell started speaking and we absolutely started zooming up. Now interest rate hikes are much more anticipated by the markets. Bear in mind, the current interest rate is down here at 4.75%, so we're a whole 75 basis points away from the Fed futures rate down to the current interest rate. So it looks like a lot more rate hikes will be coming. Outside of this as well, I don't want to spend too long on the bond market, but government bonds have been zooming up to new highs in the past week, and because of this, Once again, the yield curve, which we've discussed quite frequently on this channel, just keeps on exploding down to new lows in the past couple of weeks. And we've previously discussed, if you haven't watched the videos that we've made about this, I'll just show you this chart very, very quickly, how previous recessions have been anticipated by these previous inversions in the yield curve. So you can see we actually inverted the yield curve coming into 2006 into 2007, just before the 2008 financial crisis. The bond market, looking at the yield curve, is normally extremely good at predicting these recessions. And we're currently at the worst records recorded on this entire chart. This is something not a lot of crypto YouTubers that are telling you 100k is inbound are looking at. Now, that's basically all I really wanted to talk about for this video, my friends. For the past few days, I have been ill. I caught the flu or something weird. Don't really know what it was. So yeah, if you're wondering why, the markets were breaking down, I do apologize. Of course, we were breaking down for the past 2 days or so. I was kind of just dying in bed. But now I am back. I will be making more frequent updates throughout the next couple of days or so. This is unfortunately going to be my only update for today, though. I really do want to update the altcoins, especially Cadena, as I do see this is once again breaking down and our trade is pumping in the profit right now. However, veterans of the channel do know that on Wednesday, Thursday, Friday, I do typically have kendo training, so I'm really just kind of rushing home, recording this video, and then I'm going to be heading out. Also today, I have been busy. I gave my first presentation at a university. I was talking about how financial conditions affect the stock market, and yeah, this was definitely weird. Like I said, this is my first presentation at a university. Before, I was normally used to being on the other side of the lecture hall, but now, for once I'm on the other side. I was asked to speak at an economic conference at a university, so very, very interesting. Just a lot of things going on in my life right now, a little bit busy, but I do look forward to coming back tomorrow evening after some training has been done and getting some more updates out for you. And just very, very quickly before I do wrap up the video, there were some charts that I did talk about while I was giving this university presentation that I haven't discussed with you on the channel before, so I do just want to quickly run through these as well. If we do come over, of course, we've been looking at the federal funds rate, we've been looking at how the interest rates are going up, making credit more expensive to borrow. If you're a veteran of the channel, you'll know all about this. We've been discussing this a lot, but what we haven't been talking about is these two other charts. Now, while the interest rates are going up, meaning that borrowing is more costly, meaning that less people are borrowing, meaning that less people are borrowing to invest, and that's why the stock markets are really breaking down. While we're seeing the interest rate going up, we're also seeing the delinquency rate on credit card loans increasing. Now, this chart, the delinquency basically tells us when past credit is past due. So for example, if you've got a credit card, you've got 10,000 due tomorrow, and you're not going to pay it, you're not going to pay it for a month, you might not pay it for a year, you might never pay it, the delinquency rate will start going up because you're becoming delinquent on your loans. And back in 2008, you can see the delinquency rate was also shooting up to the upside. Now, what's very, very interesting about this is, for banks that are lending to us, for banks that are lending out credit, they're increasing the cost at which we can borrow credit. People are now becoming delinquent on their loans, and when we move over to the net percentage of domestic banks tightening standards for commercial and industrial loans, this basically shows us when this ratio goes to the upside that banks are becoming much more picky with who they're looking to lend to. So for example, in 2008 we saw the delinquency rate skyrocket, and this was because a lot of people were becoming insolvent. They could no longer pay back their credit card debt, and because of this, banks were increasing their tightening standards, meaning that banks were far less likely to lend as the tightening standards were going up. We're seeing once again right now in 2023, the tightening standards are going up, just like they were in the 2000 financial crisis, just like they were in the 2008 financial crisis, and just like they're doing at this moment in time. So the interest rates are going up, the cost of borrowing money is going up, less people are borrowing, subsequently less people are borrowing to invest, the economy is slowing down because of this, the stock market is slowing down because of this. Also, because credit is more expensive, less people are borrowing, more people are defaulting, the delinquency rate is going up, less people are paying back their loans on time, and subsequently we're seeing the same thing that happened in 2008. Now, also because of this, because the delinquency rate is going up at this moment in time, the banks are becoming much more picky with who they are lending to. The tightening standards for lending is going up at this moment in time. So interest rates up, delinquency up, net percentage of banks tightening is going up. All of these things tie in with these charts that we've been looking at in the market. Credit is more expensive. The S&P 500 is crashing to the downside. The Fed is coming out more hawkish than ever. And because of this, my friends, these are some other reasons outside of just the Bitcoin US dollar chart why I believe Bitcoin is going to be coming down to this $10,000 level. So for today, my friends, that is all I've got. Like I said, this is going to be my only video today. I am going to come back tomorrow in the evening time, get some more videos out for you, get some more altcoin videos out for you. So let me know down below in the comments section what you do want to see for tomorrow. I will check the comments before I start recording. But for today, that's all I've got. As always, my friends, if you do enjoy my content, let me know down below by leaving a like and a comment. Share the videos with your friends. And if you do want more of my content, feel free to come and follow me over on Twitter at 618_cowboy. As always, my friends, it's been your boy Cowboy Trades. I'm out. Peace.